In the previous video, we touched upon 3 key stock market strategies to maximize gains. We covered strategy 1 in detail, avoiding market tips, and how following random advice can hurt your investments.
Not say I'm doing education, but I'm claiming that my students make 5 crores a year.
Before following a stock tip from an influencer, or from anyone for that matter, check their track record. In the last video, we explored how to ride the bullish sentiment and participate in the exciting Indian growth story. But markets don't always move up. So what happens during corrections? How do you stay calm, stay invested, and continue your growth journey? In this video, we'll cover exactly what's required to navigate market corrections with confidence, stay put during the dips, and position yourself for long-term success. Let's dive in. Stock market returns are not always linear. While we've enjoyed a bull cycle over the last 4 years, it's important to remember that prior to this, there were periods of stagnation. These are the times when being stock specific becomes crucial. During a bull run, it's relatively easier to pick winners since the majority of stocks deliver good returns. Most investors are satisfied with a top-down approach, riding the wave of sectors or momentum-driven areas. However, when the tide turns and markets correct, the game changes. The percentage of stocks that yield returns drops significantly, making it essential to focus more selectively. A bottom-up approach becomes crucial as it allows us to identify strong individual stocks regardless of broader market trends. In this video, we'll explore our next strategy, which emphasizes the bottom-up approach, helping you stay ahead during challenging market conditions. Investing without research is like diving into a pool without checking its depth. You might think you're safe, but you might hit the bottom. Take recent big-ticket IPOs over the last few years. There was a frenzy among investors, but those who didn't check the financials, who followed the hype, were in for a rude shock when prices nosedived. Here is the lesson: headlines don't equal profits. Research does. Imagine an influencer whom you have been following for many months. He recommends buy stock XYZ for 50% growth. Do you buy immediately? Research the fundamentals, compare it with your investment strategy. Let me know in the comments. To make serious money, you need serious research. Influencers can guide you, but only you can decide. Stay informed, stay smart. Start with some fundamental research, like analyze company financials, their growth story, con calls, annual reports. Then also watch for market sentiment. Headlines, social media trends, they can tell you more than what you think. And don't forget the big picture. Global events, sector trends, policy changes, valuation, liquidity cycles. If you want to understand a bit more detail on these topics, please let me know in the comments, as these would require separate videos. Now that you're armed with knowledge, let's talk about spreading your risk. Ever heard the saying, don't put all your eggs in one basket? In investing, this could be the difference between profit and panic. Diversification is key to investments. Remember the tech stock rout of 2022? When soaring inflation triggered a cycle of high interest rates, severely impacting the sector. Many new investors make the mistake of betting all their money on a single stock or sector. If you had invested only in tech stocks in 2022, you would have faced steep losses as the sector struggled. Diversification can help reduce such risks by spreading your investments across different industries and even across different investment options. But here is the thing, while diversification has its benefits, it's not without its drawbacks. Limited diversification can be an advantage, but over-diversification has its downsides. When you spread your investments across too many stocks, you end up spending a lot more time analyzing and tracking, which can compromise the quality of your decisions. Considering the limited time we all have, it's important to strike a balance. What do you think? Does diversification always work? Comment below if you'd like to explore this further, and I'll make a dedicated video on this. Thanks for staying with us so far, investors. Now here's a pro tip that could make a big difference in your investment journey. Trying to time the market? Even seasoned investors rarely get it right. So why do so many of us fall into this trap? Here's the golden rule. Focus on time in the market, not timing the market. Think of investing like a test match, not a T20. The goal isn't to hit sixes in every over, but to stay longer, play slow and steady, and accumulate runs. The stock market rewards patience, not impulsive moves. India's stock market indices have rewarded disciplined investors handsomely over the decades. Let's take the recent past as an example. Since 2010, the CAGR, compounded annual growth rate, has been around 11% for the Sensex and an impressive 15% for the mid-cap index. What does that mean in real terms? A 1 lakh investment in 2010 would have grown to 4 lakhs in the Sensex and around 7 lakhs in the mid-cap index. All we had to do was stay the course, sit tight and hold without disembarking from the journey. Think back to the COVID crash in 2020. During the market close, the biggest mistake many made was panic selling. If you had sold in Feb 2020, ask yourself, would you have had the conviction to re-enter during the March lows? Here's the reality. It takes immense courage and belief to reinvest after selling at a loss. And let's face it, timing the market perfectly is next to impossible, even for the experts. But staying invested consistently beats panic selling every time. If instead of reacting to short-term volatility, we had believed in the Indian growth story and stayed invested, our portfolios would have grown multifold by now. The lesson here: trust the process and don't let emotions derail your financial journey. Are you a short-term trader chasing quick gains like a T20 cricket, or a long-term investor patiently building wealth like Test cricket? What's your strategy? Let us know in the comments. A simple SIP in the Nifty 50 over the last 10 years outperformed many lump sum investments. Thanks to cost averaging, consistent investing, even during market dips, smoothens out the highs and the lows and leads to better long-term gains. Avoid these mistakes and you're already ahead of most new investors. Which of these mistakes have you made? Comment below. I'd love to hear your stories. In the next video, we'll dive deep into a recent Economic Times article that examines the performance of Finfluencers and how it stacks up against benchmark returns. Do they really underperform? And if so, why? While we touched upon this briefly in our first strategy, the upcoming video will provide a comprehensive analysis, complete with detailed stats, comparison charts, and insights. This will help you make more informed decisions about where to invest your time and money.